A simple portfolio of just 5 ETFs could potentially outperform your full-time job. Surprising, but true. Today we're diving into a powerful investment strategy that could change your financial future. This approach has been quietly building wealth for years. You'll learn how these carefully chosen ETFs work together to potentially generate significant returns. We'll explore why this strategy is so effective and how it could put you on the path to financial freedom. Get ready to discover how you can build a portfolio that works as hard as you do. Did you know that ETFs are like a buffet of investments all in one package? It's true, and it's a big reason why so many investors love them for building wealth without the headache of picking individual stocks. Let's break down ETFs. Picture a restaurant buffet, but instead of food, you're getting a spread of investments. That's what an ETF offers, a mix of investments in one serving. When you buy an ETF, you're not just getting one company, you're getting a piece of many companies at once. It's like buying a pre-made pizza instead of trying to make one from scratch. You get a balanced meal without all the guesswork. ETFs have some great perks, whether you're new to investing or have been at it for years. They're cheap to buy, spread your risk across many investments, and are easy to trade when you need to. These features make ETFs perfect for building a solid investment plan without needing to be a finance expert. As we start building a portfolio that could potentially beat your full-time job's income, ETFs will be our go-to tool. They're the building blocks for a diverse investment strategy that's simple to pull together. Take the Vanguard S&P 500 ETF, VOO, for example. It's often seen as a great starting point for a portfolio, giving you a slice of 500 of America's biggest companies all in one. But here's the big question: how do we pick the right ETFs for our portfolio? There are thousands to choose from, each offering a different mix of the market. Don't worry, we're about to look at how to build a 5 ETF portfolio aimed at growing wealth over time. Get ready to see how these powerful tools can work together to potentially boost your financial future. The Core S&P 500 ETF. Imagine owning a piece of America's 500 biggest companies. That's what an S&P 500 ETF gives you, and it's a key part of many investment portfolios. But why is it so popular, and how could it help your investments grow faster than your job income? The S&P 500 includes 500 of the largest U.S. companies like Apple, Microsoft, and Amazon. When you buy an S&P 500 ETF, you get a small slice of all of these companies at once. This relates to the active versus passive investing debate. Active investors try to beat the market by picking individual stocks, while passive investors aim to match the market's performance with broad indices. Here's the kicker. Over time, the S&P 500 has beaten most actively managed funds. Studies show that more than 90% of active fund managers can't outperform it over 15 years. The S&P 500 is weighted by company size, so bigger companies have more influence on its performance. This reflects how these large companies impact the real economy. Why pick the Vanguard S&P 500 ETF, VOO, as our main investment? It has very low fees, spreads your money across 500 top U.S. companies, and comes from Vanguard, a company known for putting investors first. Remember though, the S&P 500 is just one piece of the puzzle. To build a portfolio that could potentially grow faster than your salary, we'll look at how to add other ETFs to this one core holding. Next, let's talk about ways to expand beyond just large U.S. stocks. Small but mighty, small cap ETF. What if I told you that some of tomorrow's big companies are today's small ones? It's true, and adding a small cap ETF to your portfolio could really boost your returns. Small cap stocks are companies worth between $300 million and $2 billion. These smaller companies often have more room to grow than big ones. Here's the cool part. Small cap stocks have usually done better than large cap stocks over time. The Russell 2000, which tracks small caps, has returned about 12% a year compared to the S&P 500's 10%. That 2% difference might not seem like much, but it adds up over the years. You might wonder, why not put all my money in small caps? Well, here's the catch. Small cap stocks can be pretty bumpy, with bigger price swings. This can be scary for some investors, but remember, more risk can mean more potential reward. Adding small caps to your mix spreads out your risk. While the S&P 500 has big, established companies, small caps are often younger and growing faster. This mix gives you both stability and growth potential. Small caps often do really well when the economy is bouncing back. Smaller companies can adapt quickly to better conditions. For example, a small tech company might ramp up production fast when demand increases, possibly outpacing bigger rivals. An easy way to get small caps in your portfolio is through the Vanguard Small Cap ETF, VB. It gives you a broad mix of small cap stocks, so you get their growth potential without putting all your eggs in one basket. Remember, small caps are great, but they're just one part of a good investment strategy. Sticking to just US stocks might mean missing out on opportunities around the world. That's why we'll look at how to invest in international markets next. Going global, International Stock ETF. Ever wondered how you can invest in the next big thing from Tokyo to Berlin? Well, you're about to find out. Let's talk about why adding international stocks to your portfolio is a must-have for savvy investors. Think of investing like exploring a global buffet. Sticking to just US stocks is like eating only one dish. By branching out into international markets, you're tasting a world of financial flavors and opportunities. You might be thinking, isn't investing in foreign markets complicated? And you're right, it can be. Different rules and changing currency values can make it tricky. But that's where international ETFs come in handy. They're like your passport to global investing, letting you buy into a bunch of international stocks without the hassle. Here's something to think about. A big chunk of the world's market is outside the US. That's a lot of potential growth you might be missing if you only invest at home. And get this, international markets don't always move the same way as US markets. Sometimes when US stocks are down, international stocks are up. It's like having a backup plan for your investments. So how can you get in on this global action? Check out the Vanguard International Stock ETF, VXUS. It's an easy way to invest in companies from all over the world, both in developed and growing markets. Now that we've looked beyond US borders, let's add another piece to our investment puzzle. We're going to explore how to bring some stability to your portfolio with something that offers both growth potential and steady income. Ready to find out what that is? Real estate, adding stability and income. What if you could invest in real estate without being a landlord? Real estate investment trusts, or REITs, make this possible. They let you tap into the real estate market without dealing with leaky faucets or chasing late rent payments. REITs are a great addition to our 5 ETF portfolio for a few reasons. Real estate has historically performed well compared to stocks and bonds, making it good for diversification. It adds stability to your portfolio while still offering the chance for solid returns. REITs also generate income. By law, they have to pay out 90% of their taxable income to shareholders. This means higher dividends compared to many other investments, giving you regular income on top of potential growth. Picture your portfolio growing while you get dividend payments you can use or reinvest. That's what REITs offer. Many experts say a balanced portfolio should have about 10 to 15% in real estate investments. REITs can also help protect against inflation. As prices go up, property values and rents tend to rise too, helping preserve your wealth. The Vanguard Real Estate ETF, VNQ, is an easy way to invest in REITs. It gives you a broad exposure to the real estate market without buying properties yourself. Adding VNQ to our portfolio brings growth potential, income, and inflation protection. It's like having a pro manage your real estate investments while you relax at home. But even with real estate providing stability and income, every good portfolio needs a safety net for rough markets. Let's look at our final piece, something to cushion the ups and downs of investing. Bonds, the safety net. Did you know that bonds could be your portfolio's best friend during stock market storms? It's true, and that's why they're so important in a well-rounded investment strategy. Bonds, especially fixed income securities, are like that reliable friend who's always there to catch you when you fall. Think of your portfolio as a ship sailing through rough financial waters. Stocks are the sails pushing you forward when things are good. Bonds are the anchor keeping you steady when the stock market gets choppy. They help your investment ship stay on course when things get rough. You might be wondering about bonds right now. We're in a time where they're not paying much, which has some people questioning if they're worth it. But even now, bonds have an important job in your portfolio. They give you a steady stream of income and are usually less jumpy than stocks, which can help smooth out your overall returns. In the past, when stocks have taken a big dive, bonds have often come to the rescue. They've acted like a safety net, softening the blow to investors' portfolios. This is why financial experts say it's a good idea to have both stocks and bonds in your investment mix. Picture your portfolio as a castle. Stocks are the tall walls, reaching high and giving you the chance to grow. Bonds are the strong foundation, keeping your castle standing even when things get shaky. By using both, you're building something that can handle all kinds of market weather. To easily add bonds to your portfolio, take a look at the Vanguard Total Bond Market ETF, BND. This ETF gives you a mix of different bonds all in one simple package. It's like having a team of bond experts working for you. By adding BND to our 5 ETF portfolio, we're putting in a layer of protection and stability. It's like adding shock absorbers to your car, helping smooth out the bumps on your investment journey. With this last piece in place, our portfolio is complete. Now that we have everything, want to see how it all comes together to create a strategy that might even outdo your day job? Ready to see how these 5 ETFs combine to create a powerful portfolio? Let's recap our picks and their roles. The Vanguard S&P 500 ETF, VOO, is our core, covering large U.S. companies. Vanguard Small Cap ETF, VB, adds growth potential from smaller firms. Vanguard International Stock ETF, VXUS, brings global diversity. Vanguard Real Estate ETF, VNQ, offers stability and income, while Vanguard Total Bond Market ETF, BND, acts as our safety net. Let's talk about how to split up your money between these ETFs. Your comfort with risk is key here. If you're young and okay with more risk, you might put 40% in VOO, 20% in VB, 20% in VXUS, 10% in VNQ, and 10% in BND. This approach leans heavily on stocks for growth. If you're closer to retirement and want to play it safer, you might prefer 30% in VOO, 10% in VB, 15% in VXUS, 15% in VNQ, and 30% in BND, focusing more on stability and income. Here's a quick tip. Subtract your age from 110. That's roughly the percentage you might put in stocks with the rest in bonds. So if you're 40, you'd aim for about 70% stocks and 30% bonds. It's just a starting point though. Adjust it based on your situation and goals. Want to get started? Here's a simple guide. 1. Figure out how much risk you're comfortable with and what you want to achieve. 2. Decide on your percentages for each ETF. 3. Open an account with a broker that offers these ETFs. 4. Invest your money and set up regular contributions. 5. Check and adjust your mix once or twice a year. The key is to stick with it and be patient. This isn't about getting rich overnight. It's about building wealth over time. Think about the potential long-term gains from this diverse portfolio. While we can't predict the future, history shows that a well-balanced portfolio can grow steadily, potentially beating inflation and building significant wealth. But could this strategy actually outperform your day job? Let's explore that interesting idea. Investing consistently can lead to substantial wealth over time. Here's a concrete example. If you invest $500 monthly into this 5 ETF portfolio, with an average annual return of 8%, you could potentially have over $340,000 in 20 years. That's compound interest working hard for you. The key is to start now. The sooner you begin, the more time your money has to grow. So, what should you do next? First, open a brokerage account if you don't have one, then set up automatic monthly contributions to your chosen ETFs. This way, you're investing regularly without thinking about it. Keep in mind that investing is for the long haul. Your portfolio will have ups and downs, but historically, the market has gone up over time. Focus on the big picture: financial freedom. With smart investing, you could potentially build wealth that exceeds your full-time job income. Ready to take charge of your financial future? Don't put it off. Open that brokerage account, set up your portfolio, and start investing today. Your future self will be grateful for the steps you're taking now. The opportunity for financial growth is right in front of you. Grab it.